Hey, it's George Coyle, founder of Triangulated, back today with another video. This one's going to be talking about drawdowns. And this video will fit into both the traditional investing and the trading categories because it basically applies to both. So I put together a little presentation and we'll jump into that now. Okay, so let's start with a little definition of drawdowns. So a drawdown is an industry term that refers to how much an investment account is down in percentage terms from the peak before it recovers back to the peak. So best to figure this out with a quick example. If you start with 100 and your account goes down to 50 and then goes back to 100, you were down 50%, so that's a 50% drawdown. Similarly, if you start with 100, go to 75, go back to 100, you were down 25, so that is a 25% drawdown. If you'd like to know more about this, I have a little segment on my website and I'll provide the link below. But the key takeaway here is just so that you understand what a drawdown is. So in terms of measuring drawdowns, you can use daily data, weekly data, monthly data. A lot of times it depends what's available, but daily data is going to be more accurate than weekly. Weekly is going to be more accurate than monthly. For example, daily data might pick up a 50% drawdown where weekly might show 40% and monthly might show 30%. The point here is that the less frequent data doesn't capture as much because it doesn't capture every day in between. And the more granular the data, the more accurate you can estimate the drawdown and therefore the ride that you're going to experience when you do the investing or trading. So let's look at some examples because that's, I think, the best way to illustrate it using daily data. So here's a chart, a drawdown chart, I should say, of the S&P 500 since the year 2000. And what this basically shows is that if you had bought the S&P 500 in the year 2000, by the year 2002, 2003, you were down almost 50%, just shy of 50% at the low here. And it took you until about the year 2007 to get back to even. So we would say that this was a 48%-ish drawdown that took 6 to 7 years to recover. Similarly, if you had bought the S&P 500, hopefully you can see my mouse here, but in 2007, you experienced a 55% drawdown and you didn't get back to even, back to the zero line here until about the year 2012 or 13. So that was about a 5 or 6 year drawdown depending on the specific dates. So that established, let's look at a couple other markets so you can get a feel for it. So the NASDAQ 100 Triple Q ETF, if you had bought this in the year 2000, you would have experienced an over 80% drawdown. So from where you got in to the lows, you would have been down 80% on your money. And it took basically from the year 2000 until the year about 2015 or 16 to get back to even. So that means you had an 80+% drawdown that lasted for 16 years. Nothing to scoff at. Here's an example of the 20+ year bond ETF, which is TLT. And you can see up until recently, it's been pretty good at drawdowns, nothing more than about 25-6%. But when the Fed started to raise interest rates for the first time in a long time in 2022, the TLT ETF took a big drawdown, and it's currently down just shy of 40% versus the highs from 2020. And here is yet another example. This is a 60-40, so 60% S&P 500 SPY, 40% bonds TLT. And it shows that the drawdowns of a 60-40 portfolio in the 2008 period, that portfolio was down about 30%. If you had bought in 2007, you would have experienced a 30% drawdown and you wouldn't have been back to even until about 2010. So that's about a 3-year drawdown. Similarly, over here in 2021-22, again, the Fed started to raise interest rates, but you experienced about a 27% max drawdown, and it took you until 2024 to get back to even. So about a 27% drawdown here that took 3 years to recover. Okay, so let's talk about another concept that's related, and that's maximum drawdown. And maximum drawdown basically measures the lowest point in terms of your drawdown on this chart. So in this case, we can see here we were down just short of 50, but here the S&P was down 55%. So the maximum drawdown would be the lowest point on this gray line, and that's about 55% for the S&P 500 since the year 2000. So in my experience, the single most important factor in investing or trading is really the maximum drawdown. And I'll tell you why. People can tolerate middling returns. They can tolerate not making money, but what they can't tolerate, as evidenced by the little cartoon face here, is big losses. When people hit big losses, which are big drawdowns, they panic, they sell everything, they run for the hills. And so to me, you need to focus on something that you can actually tolerate and stick with, because if you panic in a gigantic drawdown, you won't be able to come out the other side of it. So you need to really consider the maximum drawdown in your investment and whether or not you can handle that. I think that's really just the most important thing. So let's talk a little bit about how bad drawdowns can get. The previous charts give you kind of an idea of how they can get since the year 2000, but that's really not the best representation of potentially the long term. So, for example, the S&P 500 stock index had a 30-year 80% drawdown that ran from the late 1920s until the mid to late 1950s. So that's extreme. Similarly, using annual data, and the point here is that annual data doesn't pick up as much as daily, but it's hard to find bond returns back that far. A 60-40 stock bond portfolio on annual data had a 40% drawdown in the 1930s. One of the things that traders say, great traders say, is that any market can do anything. And so that means that drawdowns can get really ugly. If you want to know more, I'd invite you to watch the video I made recently that talks about buy and hold assumptions, and I'll provide a little link to that below this video. So how to manage drawdowns? One way, as we saw in the earlier charts, is diversification, but there's really no promises. Sometimes things like stocks and bonds have played well together historically, but there's no guarantee they will in the future. As a prime example, if you look at the 60-40 max drawdown since the year 2000, it was about 30% using dailies. But if you go back to the 1920s, you find that the 60-40 using annual data was down 40% or more. How much was it down if you could look at daily data? 50, 60? I don't know. But you can get really ugly drawdowns with diversified portfolios because markets may not play nice together. And if you just look at the last 20 or so years, it may not be a really apt representation of what's to come. So diversification is one way to manage drawdowns, but it is a potentially flawed way. The other thing is trader principles. And I made a video about this kind of generically that I'll link to below, but I'm going to make more videos coming soon for this series so you can learn a little bit about that and how to do it. So let's recap here. Okay, drawdowns measure losses, realized or unrealized, from highs. Drawdowns, in my opinion, are the most important factor in investing because big losses is what causes people to puke their investments and try to do something else, and they miss the upside. Diversification can help to manage drawdowns in theory, but in practice, you just never know. Trader principles, again, I made a video about and I've written a book or pamphlet about, they can take actual action to manage drawdowns. So that's basically it for today. I'll be back with more videos soon, and thank you for watching.